A Year for Accumulation with Monex, featuring managing partner of CPM Group and author of the Monex Precious Metals Market Outlook Report, Jeffrey Christian.
Hello, I'm Sean Brasney. I'm here with Jeffrey Christian from CPM Group. Thank you for joining us, Jeffrey.
It's always a pleasure to be with Monex.
Thank you. Main topic today, starting off, is the trade talks with China, causing quite a bit of uncertainty with on again, off again. In your opinion, is there an end prognosis to this, and do you have an opinion of how it might affect the precious metals market?
Yeah, we do think that there'll probably be a trade agreement within 2 or 3 months. We think it'll be beneficial to both sides in many ways. If you look at what's been happening over the last 8 or 9 months that we've had this trade war going, the Commerce Department has issued enormous numbers of waivers on the tariffs for aluminum, steel, and other assets. So the trade war hasn't had as negative an effect on the actual economy in the U.S. as you might think. What it has done is created a tremendous amount of uncertainty in the financial markets. That's been beneficial for gold and silver over the last 3 quarters and bad for the stock market. Our expectation is that when the trade agreement is reached, it'll be good for the stock market, it'll be good for the U.S. dollar, and there may be some downward pressure on gold and silver at that time because of the removal of the uncertainty related to the trade war, although, depending on what's going on in other sectors of the economy and political world, the downward pressure on gold and silver may be very minor.
Second main topic for us leads us to next week and the Fed Open Market Committee meeting, which I believe is the 19th and 20th. In your gold outlook, you mentioned a first half and second half prognosis for rates. Would you be willing to share more details on that?
Absolutely. And, as you said, it's in the gold outlook. Our view is that the Fed is looking at the economy pretty much the same way that we are, that it sees a lot of short-term strength and long-term problems in the economy, and that it doesn't necessarily think that the economy is in a particularly bad place right now. We see relatively strong growth. We see modest strength in inflation, but not runaway inflation. So I think the Fed will continue to pause in March. We won't see an interest rate increase then. But that if you get into the second half of the year and you're seeing stronger economic expectations, then you might see the Fed resume its interest rate increases 1 or 2 times, but only in the second half of this year, probably not in the first half.
The U.S. dollar has been trading kind of at the top of its range for about, at least it's hit the top of the range a few times over the last almost 2 years. And do you have an opinion on both the short-term and long-term direction of the dollar?
Yeah, we had thought that the dollar would probably rise modestly over the course of this year, and it has so far. It's at the top of this range that it's been in. We don't see it running away to the upside, but again, if and when you see a settlement of the trade issues with China and perhaps some other positive economic indicators, what you're going to see is increased demand for U.S. dollars on the part of foreign investors wanting to get back into the U.S. stock market, and that'll increase the upward pressure on the dollar. So we think the dollar can rise a little bit over the next several months, but we don't necessarily see it running away on the upside.
You also mentioned in your outlook about gold being at the end of 2018 at historically very high levels, in spite of one of the strongest periods of stock market gains and economic growth. You mentioned that it's occurred because of numerous underlying risks in the global economy. Would you be willing to share more of those risks with us?
Sure. The reality is that the gold price has fallen. It's $600 lower than its intraday peak. It's $300 lower than its annual average 9 years ago, but it is far higher than it was at any time prior to 2010, 2011. And we think that that it's formed a very solid base. This ties in with what we were saying about the Fed's views of the world and our views of the world and real world. I think most people that we talk to are looking at the world and they're saying there's a lot of strength in the U.S. economy, Chinese economy, parts of Europe at this present. there are long-term problems that are on the horizon, but they may not come home to really have a negative impact on the economy for a while. And you're seeing that in the Fed policy, the willingness to pause, but also keeping an eye on the long-term outlook. The biggest imbalance that we're looking at is, of course, the growth of debt. U.S. federal debt deficits and debt are skyrocketing, but U.S. corporate, consumers, and non-U.S. debt, both government and private, are also rising. We've seen an extended period of time where debt has been growing 11-12% per annum on a global basis. And that's long-term unsustainable, and everyone knows it. It also has implications for the U.S. dollar. There are big imbalances in the currency market. You've got about 75% of private wealth denominated in dollars, about 62% of government wealth denominated in dollars. A lot of people would like to diversify away from the dollar if they could, but that has incredible inflationary consequences for other countries, and it also has implications for the U.S. economy. So, and then you have political imbalances that have yet to be resolved, both internally within countries, growing inequality and the rise of the Gini index, as well as between countries and governments. And so you've got a lot of long-term imbalances that have yet to be dealt with and have probably gotten worse since 2008, 2009. So a lot of people, including the Fed and the United States and CPM Group, look at this and we're cautious and we're worried about the long-term implications of these things. Sooner or later they have to be resolved. They haven't been resolved for 40 years, which has caused some people to be a little bit complacent about them. But over those 40 years, they've grown worse and worse, and right now you've seen an acceleration in deficit and debt issues, which means that you're probably getting to a point where they're going to have to be dealt with, and there doesn't seem to be a political mechanism to deal with them effectively. So you're kind of looking at a repeat of 2008, 2011 at some point.